Okay, well, welcome to the High Probability Trading course, Light, with Garth Mackenzie. We're very happy to have you guys join us. I'm going to do a quick intro for Garth. I don't know, Garth, I actually don't know how long ago we met, but it's probably decades now. Just to give Garth, I'm sure you guys know Garth from Business Day. He obviously ran the Traders Corner TV show for about a decade. I think it was 2009 to 2019. Yeah. He now hosts the Talking with Traders podcast series. And before that, he was with BOE Stockbrokers, who were running their derivatives desk. So a wealth of experience. I think many of you know Garth. And what we've asked him, he's going to do this, obviously a five-week mini course in high probability trading. Every Thursday at 5:30 for the next 5 weeks. We are going to make it available on YouTube as well. We also have a couple of prizes to give away to viewers, which is fantastic. So it's, I suppose, not sponsored, but when TradingView saw that we were doing this event, they quickly phoned us and said, "Hey, would you like to give away some TradingView subscriptions?" So we said, "Sure. Why not?" So anyone that's on the call, we'll do a draw probably on the fifth edition, so the fifth crossing, and we'll be giving away 3 free professional TradingView subscriptions to viewers. I'm going to hand over to Garth. Garth, you'll tell them if you want questions during or after, but I hope you guys enjoy it. Garth is a wealth of experience and knowledge, and I hope you find it beneficial.
Super. Okay, Gary, thanks very much. I'll take it over from here then. Welcome, everybody. It's good to be here with you. Good to be representing Rand Swiss for the first time in this capacity, and excited for the next 5 weeks. We'll be doing this every Thursday for the next 5 weeks, with the last one being on whatever the 5th week is from now, sometime in early December. Now, with this course, I've called it High Probability Trading Course Light, because it is exactly that. It's light. I mean, we're just touching on some of the most important aspects of what I do on that bigger High Probability Trading course, on the online course. So I've split it into 5 weeks to make the most sense out of each of these major themes that I want to talk about. So the one we're going to be doing today is playing in the right sectors, and talking all about relative sector strength and looking into the sectors. And specifically, we're going to be looking at US markets in that respect. So I'll take you to the S&P 500, and we're going to go through each of the major sectors in the S&P 500. And then what I'll also do is actually pick on 2 of the sectors and look at the stocks that make up those sectors, and look at the relative strength in each of those. Then the following weeks, we're going to do high probability chart patterns for next week's session. Then the third one is going to be risk management and money management. That's the secret sauce, as I've named it. I think that if there is a holy grail in trading, it all is probably to be found in the money management and risk management part of trading. And then putting it all together in terms of how you build a playbook, or like a trading plan, if you like. So we'll tie it all together. And then the last section, the last week, will be putting it all in the box. And I have a thing called the box trading method, which is how you can apply all of these things that I'll do in the first 4 weeks, but how you can actually apply it in quite an interesting way in what I term the box trading method. Right. So for today, though, we're talking about playing in the right sectors and understanding relative strength analysis. And that's for today's section, with us being on the 3rd of November today. So first up, what is relative strength analysis? It's, as it says there on the slide, it is a ratio of a stock price performance relative to a market average performance, or a ratio of a market sector performance to a broad index performance. That's what we're going to be looking at today. So as I've got there an example, looking at the US technology sector versus the S&P 500. And the whole idea here is it's a relative strength analysis. So it's looking at 2 instruments alongside one another and understanding which one is performing better than the other. All right. So think about it like perhaps 2 cars driving along a highway, on a dual carriage highway. One car's going 100 kilometers an hour and the other one's going 120. right? The one that's doing 120 kilometers an hour is obviously the one that's outperforming out of the two. They're both going in the same direction, but one is outperforming the other one. Okay, so that's what we talk about with relative strength analysis, and we'll get into this in greater depth now as we go through all the slides. Just at the bottom there, I've got a note not to be confused with relative strength index. So if you know a little bit about technical analysis, you may have heard of the RSI, and that's actually a momentum indicator that you have on your charts, and it sort of oscillates up and down like a squiggly line at the top or the bottom of your chart in its own window usually. That's relative strength index. That's different. Right, we're not talking about the relative strength index here. Here, we are talking about relative strength comparisons of one thing against another. Okay, it'll make more sense as we get into it. So, like I said, we're going to focus in on the S&P 500. That's, of course, the most widely followed index in the world, the 500 biggest stocks in America. And the S&P 500 is broken down into 11 major sectors. So the sectors are these: energy, real estate, healthcare, industrials, materials, consumer staples, financials, utilities, consumer discretionary, information technology, and communication services. All right, so 11 major sectors. Beneath that, you do also get what's called industry groups in the US, and that's it's zooming in a little bit more closely on the individual industries. So, within healthcare, for example, you might have a couple of other industry groups that fall under healthcare. But for the purposes of the analysis today, in this exercise, we're just going to start by looking at these major 11 sectors, all right, and how they all look relative to the performance of the S&P 500. Now, the thinking behind all of this is to basically take the different areas of the market and decide which ones are outperforming, which ones are underperforming, and which ones are neutral. And you almost put them into a bucket. Okay, so as I've got it on the slides here, on the left-hand side, I've got a red bucket for the underperformers. In the middle, the neutral bucket for stocks that are kind of not outperforming and not underperforming. They're more or less performing in line with the broader market. And then the outperforming bucket, which is indices or sectors in this case, that are performing better than the overall market. All right, so what I'm showing here is just a slide that I screenshotted yesterday. It's off stockcharts.com, which is the charting platform that I use for a lot of my offshore charting. And I'm going to get onto that platform in a moment and actually show you live how we do this. But this is a relative strength screenshot of those major sectors of the S&P 500. So, and it looks back over 3 months, by the way, this particular one. You can select the time, whether it's 3 months or 1 month or 6 months, you can decide. But here it's 3 months. So it shows you that on a 3-month basis, the energy sector has been the strongest performing sector on a relative basis versus the S&P 500. It's outperformed the S&P 500 by 25%. Okay, then the second best performer has been the financials. The third best performer has been healthcare, then industrials. And then if you go to the bottom here, the worst performing areas of the market have been communication services, which includes things like Google and Facebook, I think, is also in there. So these are some of the stocks that have really not done very well lately. Real estate speaks for itself, and consumer discretionary, that's Tesla, is in consumer discretionary among many other things. But there you can see the way the US market has been divided up into all of these sectors and how each of those sectors have performed versus the S&P 500 on a relative basis over the 3-month period. Now, of course, the ideal over this period is that you would have been wanting to focus your long trading in the energy sector, because that's where the momentum has been the strongest and prices have generally been trending higher in that sector. And if you've been stuck down here in the communication services sector, well, then you've had a very horrible time of it lately. If you'd been short in the communication sector, you would have done better. Okay, so if I had to now take it back to this exercise with the buckets and say, well, let's take all of those 11 sectors that I've just shown to you and decide where do these each belong, which bucket do they go into. Well, then in the green bucket, we've got energy, financials, healthcare, and industrials. Those have been the areas of the market that are outperforming. In the neutral bucket, materials, consumer staples, and utilities. And then in the left-hand side here, in the underperforming bucket, there's technology, consumer discretionary, real estate, and communication. All right, so what I want to do now is look at the energy sector. And what I'll do is, in fact, just go back a step from here. I'm going to exit this share or create a new share. Sorry, just give me a second. Right, share that screen. Now you should be able to see my screen that's got stockcharts.com on it. Now I'm logged in. I am a paying member of stockcharts.com. You can sign up for free, and there's quite a lot that you can do for free on stockcharts.com. But if you want to do a lot of the more interesting stuff, like filtering and screening for stocks and creating specialist watch lists and so on, and you need to pay for it. And I pay, I think it's $24 a month for the subscription, and that I'm an extra member. So that's not the best top of the top membership. That's just like a basic membership, but it does what I need it to do. Now, for what I'm wanting to show you here in terms of this is look at each of those sectors relative to the S&P 500. So what I'm going to do is come down here. Now, these that I've got here on this are all effectively watch lists that I've created. They're all there. Stock charts do offer a lot of pre-created watch lists as well, but these are all ones I've effectively split up all the different sectors of the US and all the subsectors and industry groups. So I've got quite a lot of charts here, and I've got charts for ETFs, etc. But what I'm going to do here is I'm going to go and look at the sectors, the S&P sectors versus the S&P 500. Okay, and there's 11 charts in this. So there's that, pretty much what you were just looking at on my PowerPoint slides a moment ago. This is showing you now on an intraday basis. So this is today, just today, how these sectors are stacking up in the US right now. If I want to then make it, make it 1 week, we can do that. I can see which have been the best performing sectors this week and the worst performing sector. Like I said, I did 3 months on that previous slide, and there you can see it shown there. Again, energy at the top, communication services at the bottom. And if you want, you can even go go back a year and see which sectors have performed the best over a year and which have performed the worst over a year. So, I mean, again, energy has outperformed by nearly 100% over the S&P 500. So that's been an amazing area. All right. So that's the summary. But what I'm going to do here for the purposes of this exercise is I'm actually going to show you a chart list. So what it does is it basically breaks it up into 10 charts per page. But doing this allows me then to explain what I mean by this, in case you're not following correctly in terms of what I mean by relative strength analysis. So what this chart is, this is just the first of the 11 sectors that we're going to look at. This is the communication services sector relative to the S&P 500. Now, don't worry yourself too much about the numbers on the right-hand side here, because they're relatively meaningless. What you really want to worry yourself with is the shape of the graph. And in this case, it's quite clear that that graph is going down and to the right, into the bottom of the page, and it looks like it might even fall out the bottom of the page soon. So what this is doing and how you get to this is you effectively take the values of the communication services sector in this case, and you divide those values by the corresponding values of the S&P 500. And you do that every day going back in history, and then you take the resulting values and plot it onto a chart. And that's what this chart is. And that's why I say don't worry about the numbers on the right-hand side, because they're quite meaningless. What you really want to look at is the shape. So if the shape of the chart is pointing downwards, like this one is pointing sharply downwards and to the right, then that means that this sector is underperforming the S&P 500 quite badly. And remember, the purpose of this exercise is to understand what sectors of the market are outperforming and what sectors are underperforming. And the thinking really is that this is like laying the groundwork for your research, if you will. You're trying to understand what areas of the market are performing the best and what areas of the market are performing the worst. And then if you're a trader with a bias on the long side, in other words, you're wanting to buy something with the intention that the price is going to go up, the higher probability for you is actually to go and play in the strongest areas of the market where there's outperformance. Because the thinking is that that momentum tends to continue longer than people expect. And the trend is your friend, right? That's the old saying, the trend is your friend. So you have a higher probability of being successful if you're playing in the strongest area of the market, assuming you want to be long. On the other hand, if you want to be short and you bearish, well, then you want to look in the underperforming areas of the market, because that's where you know that the negative trend, the negative momentum is on your side. All right, so what I've got there is the communication services sector, but let's now go through each of the others one by one. So here we've got consumer discretionary relative to the S&P 500. And again, you can see it's kind of trending lower. It's had its moments of outperformance, but it's mostly trending to the downside. I said to you before that consumer discretionary has Tesla in it as a big component, and Tesla's share price has come off quite hard over the last month and a half. And that's reflected in that underperformance over there since middle of September. Right. So again, yeah, I look at this and I see that this relative strength chart is underneath all the moving averages here. It's below the 50-day moving average, below the 200-day moving average, below the 15-day exponential moving average. It's pointing down. Generally speaking, to me, that is showing underperformance. And I'm often most concerned with what I'm looking at here in terms of the last 3 months of trading action and what does that look like. And in the last 3 months, it certainly have been underperforming, but if you go back even further, it's been underperforming for a year. Right, then let's have a look at this one. This is now consumer staples relative to the S&P 500. Now, I remember when we looked at this in the table, in the summary table, it came up as one of those neutral sectors, which is about right, because if you go back over the last 3 or so months, you'll see that the shape of this chart has been going sideways. In other words, it's been performing more or less in line with the movements in the S&P 500. It hasn't been stronger, it hasn't been weaker. But if you do go back further, you can see that actually it has generally been an outperforming area of the market over the last year. And when I look at the shape of that chart, I kind of look at it and think, okay, that generally speaking does look bullish. I mean, it's not super bullish, but it's fairly bullish. It's definitely not bearish. And if there was to be any dips down into this sort of area where my mouse is now, that's possibly an area where one might start looking at some of the consumer staples stocks to get long of, based on the fact that you've got this bigger, longer term trend of outperformance. Consumer staples are things like your, food producers and those, consumers, the basics, right? Toilet paper, so like Johnson & Johnson and those kind of companies, right, that are in consumer staples. And it kind of makes sense that these sort of businesses should be outperforming in such a tough economic environment, because they are defensive in nature, right? You still got to eat, you still got to go to the toilet, you've still got to, shave and wash. So those kind of businesses are defensive, and they do tend to outperform in a risk-off environment like we are in at the moment. Okay, so keep that in mind. Okay, then we move on to the energy sector. Now, this has been the darling of the market for the whole of this year, right? And there you can see it very clearly. This is, again, just to reiterate, it's a relative strength comparative chart of the energy sector versus the S&P 500. Now, the fact that it's moving up and to the right indicates that this is strong momentum, and that energy stocks are solidly outperforming the S&P 500. This chart is above all of its moving averages, above the 50-day moving average, above the 15, above the 200-day moving average. It's bullish, okay? And what that says to me is that if you're wanting to play the market from the long side, when I'm talking a shorter term trading approach here, if you want to trade the market from the long side, you're probably going to have a fairly high probability of success in this sector versus something else like the communication services sector, which is so incredibly bombed out. And to this point here, yeah, a lot of you might look at it and say, okay, but so Google is a stock that's in the communication services sector, very bombed out. Isn't it cheap now? And I'd say, well, you could say it's cheap. It might have been cheap 2 weeks ago as well, when it was 20% higher, right? And 2 weeks before that, when it was higher still. So the point here is that we're talking about shorter term trading, and we're trying to understand what areas of the market have the best relative strength and which have the worst relative strength, because that'll give you a base to work from in terms of identifying high probability trade setups. So energy is, for now, where the action is. And again, think of it like this. Think of swimming in a river. If you want to swim in a river and you want to get somewhere in that river, you want to swim with the flow of the current, right? You're not going to try and swim upstream. It's going to be hard work trying to swim upstream in a river that's flowing downwards. If you want to get somewhere, swim with the flow of the current. And that's really what this exercise is doing for us. It's trying to identify which way the flow is moving in each of these sectors of the S&P 500. And you want to align yourself with the flow in order to get the best and the highest probability of success. Right, then this is the financial sector. Again, I said it was an outperforming area of the market, and certainly over the last 3 months, you can see that. It's been just making nice higher lows and higher highs since August. And again, it's above all of the moving averages. So once again, that ticks the box as being one of the outperforming areas of the market. Then healthcare is also a strong sector of the market. Again, the chart is performing well, heading up into the top right-hand corner of the page, above all the moving averages. So healthcare also is a good sector to be in and to be playing in on the long side at the moment. Then this is the industrial sector. So again, also showing decent outperformance over the S&P 500. And you can see it's made quite a sharp move to the upside on a relative strength basis, again, above all of the moving averages. So industrials are one of those stronger areas of the market. Then information technology, right? So this is, it was the darling of the market before, no longer the case. Growth stocks, which is where you typically find your information technology stocks, the technology sector has really been outperforming this year, underperforming. You notice it's below all of the moving averages here. It's trending down into the bottom right corner of the page. Technology is underperforming. And a big part of the reason for that this year has been because we've moved into a higher interest rate environment. Higher interest rates are a massive headwind for growth companies. And valuations of those growth companies then need to be trimmed back. So that's why in a rising interest rate environment like we've seen this year, your growth companies don't do well. And that's why we've seen technology underperforming so badly this year to date. And it continues to underperform. So, if you've been trying to bottom pick some of the technology stocks this year, you've really had a tough time of it because the momentum is against you. All right, you would have actually been better off shorting those stocks on the way down. Then materials. Now, materials refers to the miners. So we think about Anglos and Billiton in South Africa, but I mean in the US, you've got stocks like Freeport, McMoran, and Alcoa, and these sort of things. Materials, basic materials. So here it shows that over the last 3 months or so, this chart has mostly gone sideways. So it's a neutral sector of the market as far as I can see. There's no reason to be super bullish on materials, but also at the same time, I wouldn't be super bearish on them either. They're kind of neutral. Then real estate is one of those areas that's been horribly underperforming as well. In fact, it's with this and communications services are the weakest sectors of the market. So there you can see the real estate sector heading into the bottom right corner of the page. And of course, real estate also an area that is very sensitive to rising interest rates. And particularly since the Fed got a lot more hawkish, the underperformance has been even more stark in the real estate sector here. So again, if you've been short-term trading, you've been better off trying to short the bounces in real estate rather than trying to catch a falling knife. All right, and then I think there's one last chart. It's this one, yeah. So this is now utilities, utilities versus the S&P 500. And again, it's sort of on a 3-month window, it's sort of neutralish, I suppose. But in a bigger picture context, it is slightly outperforming the broader market. Your utilities are things like electricity companies, water companies, those sort of basic utility type providers. All right, so if we just go back to my PowerPoint slides again here. Why is it? Sorry, I've got the wrong share going here. Just bear with me a second. It is this one. Sorry about that. Okay. Yeah, I think you can see that. Let me just open it up. All right, so what I was saying, having done that exercise that we've just gone through, is this is how we've separated the stocks into those various different buckets. So you've got in the green bucket, energy, financials, healthcare, and industrials. In the middle neutral bucket, materials, consumer staples, and utilities. And then in the weakest bucket, technology, consumer discretionary, real estate, and communication. Now, what I want to do next is go and hone in on that energy sector of the market. And we'll do that same thing. I'll go back onto stock charts now and actually drill into the energy sector, because it's all very well now we've put all of the major sectors into these 3 different buckets. But now let's go and have a look at each of the sectors on their own. And we don't have time to go through all of them today. So I'm going to just quickly look at energy. And then we're also going to look at the communications sector afterwards as well. But the idea now is to say, well, we know that energy is a strong area of the market. But let's now go in and actually have a look at the stocks in the energy sector to try and then understand for ourselves which ones are outperforming and which ones are underperforming. Okay, so what I'll do is then go back to this stock charts over here. I hope you can see that. And I'll go back to my dashboard. What I'm going to do now is basically go into the energy sector, okay, which is this here. I've created that on my watch list. Okay. Now what I've got is a summary here, which shows all of the stocks that make up the energy sector. And then again, these little green bars, they tell you which ones are outperforming and which ones are underperforming. Now, the way it's reading right now, that's an intraday move. So it's telling you today, ConocoPhillips is the strongest in the energy space. Apache Corp, Marathon Oil, these are the strongest. But let's go back and look at it over 3 months and see, right? It'll show you there. Over 3 months, ConocoPhillips is your strongest. Schlumberger, Marathon Oil, Apache, Hess Corp, etc. And then down the bottom here, these are the ones that are performing the worst. So Kinder Morgan, right? Williams Companies, Cabot Oil and Gas, Baker Hughes. These are the weakest performers in the energy sector on a relative basis. But what I'm going to then do is just go and have a look and do a chart list. And I'm not going to take a lot of time because I know we've only got an hour, so I'm not going to spend ages on this. I'm going to whiz through these charts quickly, but just have a look here. I mean, these are some of the energy stocks. And the idea with this exercise now, just to reiterate, is that we know energy is a strong sector of the market, but let's now go and have a look at the stocks themselves and try and understand which stocks are setting up. And this kind of leads us into next week's session a bit. But what I would do now is say to myself, right, I want to go and have a look at each of these energy stocks and have a look at how they're setting up and which ones I potentially want to identify and where can I see chart patterns that appeal to me. Okay, but there's Apache Corporation. You can see, nice, strong, making new highs, higher lows and higher highs. Baker Hughes, right? It's not as strong as some of the others. It's okay, but it's certainly, that is not a chart that lights my fire particularly, but we did say it was one of the weaker ones in this energy sector. Coterra Energy, okay, it's above all the moving averages. It's moving higher. right? There's ConocoPhillips. Now, remember, we said that ConocoPhillips was the strongest stock in the energy sector, both on a 3-month and on a current intraday basis. And there you can see it quite clearly. I mean, that stock is very, very strong, making new highs. This is one you want to be buying dips into. Yeah. Notice how every time it's pulled back to this 15-day moving average, it seems to be finding support. So that's one that I'd keep on my radar. And so any dips in the stock, you probably need to be looking at potential opportunities to buy it, because the momentum is strong here. And that momentum often continues longer than what you might expect. And CVX, that's Chevron Corporation, also pretty strong, close to new all-time highs there. Devon Energy, right, it's come off quite hard there. But nevertheless, not far from new highs recently. Okay, EOG Resources, strong chart. Diamondback Energy, right. I think what I'm going to do, because of time constraints, I'm not going to go through everyone. I think there's about 30 odd stocks in this sector. And if I'd looked and talked about every single one, we might be here for quite a while. So yeah, I'll just whiz through them, and if I see something interesting, I'll talk about it. So here's Halliburton. So this is interesting. What I see potentially is there is a possibility that there's a little bit of like a bull flag setting up here. So that's the kind of stock I would put on my watch list as a high probability buy, because I know the momentum is on my side. I know the sector is strong. If this stock starts to break out above those recent highs of the last couple of days, it's probably heading higher. That to me would tick the box of being a high probability trade on the long side. Okay. Let's go to the next one. Hess Corporation, also similar thing, like a nice little, either a flag or a triangle potentially setting up here. It's strong. There's no overhead resistance above. It's got lots of momentum on its side. That's the type of stock I would potentially be wanting to buy from a short-term perspective. And I know some of you might be there saying, yeah, but hang on, Garth, it's so overbought. Why are you wanting to buy a thing that's run so hard? Sure, it is, but often these things can continue for longer than you expect. And in addition, remember with trading, short-term trading, which is what we're doing here, you'd put a stop loss underneath the bottom of this pattern. So if it doesn't continue to the upside and it begins to turn lower, well, I'd have quite a tight stop loss there anyway, which would save me from losing too much money. It's different to investing. And this is something I always say to people: be careful of the difference between trading and investing. You know, when we're talking trading, which is what we're talking about here, it's shorter term in nature, and you're going to have stop losses and you're going to be quite active getting in and out. So, you know, you want to be on the side of the momentum. If you're an investor and you've got money that you're wanting to stick away for 10 years, and right now you think, you know, Google is cheap because it's fallen so much, well, that's a different story. But that's a whole different way of approaching the market as well. What we're talking about here is high probability trading, and I mean, you know, relatively short-term trading. And that's why we want to be on the same side of the momentum of the market in the short term. Right. Then Sinclair Corporation, strong chart again, making higher lows and higher highs. Looks like it's about to break fresh new highs again there. All right. So these are all the energy stocks. As you can see, most of them are strong, right? There's Marathon Oil, again, making new highs above all of its moving averages. It's got strong upward momentum behind it. That's the type of stock you'd be wanting to look for opportunities to buy in order to get on board with that upward momentum, right? Right, and Occidental Petroleum. And this is an interesting stock because Warren Buffett has gradually been buying. In fact, every time it dips below $60 a share, Warren Buffett is buying aggressively. And I think the plan for him ultimately is that he's going to take the whole company out. He's got approval from his shareholders to buy up to 50% of the issued share capital in this company. I think he's up to about 25% so far. And you probably find that once he gets to 50%, then he's going to look at make an offer to minorities. So it's a strong stock in a strong sector, and you know that you've got Warren Buffett behind you buying it into weakness, strong relative strength. You know that you've got a fairly safe, comfort blanket with a stock like that. All right, let me move away from that and go back to, just go back to my slides quickly. All right. Excuse me, clearing my throat the whole time, just got a bit of phlegm in my throat. Sorry, I'm just trying to get so I can open this up for you. Just bear with me 1 second. Struggling a bit with my laptop here for some reason, trying to get this PowerPoint presentation up. There we go. That's what I'm trying to show you. All right. Then what I want to do then is just quickly have a squiz through the communication sector. And that's now obviously the weakest sector in this whole market. And it's the weakest in that bucket of weak stocks that we've spoken about. So what I'll do here now is to get back to my stock charts. And I'm going to go quickly have a squiz through the communication services sector. All right. Just get a check communication services. Now there's also a lot of charts in this that I could go through. So I don't want to take too much time, because I do also want to leave time at the end for questions, and leave you with about 15 or 20 minutes for questions. So we'll whiz through this quickly. But remember, communication services was the weakest area of the market, underperforming on a relative basis, and on an absolute basis, it's also very weak. So this is where you'll see a lot of charts that are in downward trends and making new lows. So Activision Blizzard is one of those. Trend heading a bit weaker, looks like it's about to break to the downside here. Charter Communications also has been pretty weak. You see that with all of these weak stocks, if you were looking to try and short the bounces in these stocks, you would have probably you would have done fairly well, because the momentum is on your side. If you're shorting it, you know that the momentum is downward and there's plenty of selling pressure into the bounces. Again, Comcast, same story. Look how weak it is. Lumen Technologies, look at that very nasty break to the downside there today, below the bottom of this rising wedge pattern. Now, you know, your technicals would have said to you, you should never be long in a stock like this anyway. Today, I see, what is it, down 15%, right? That's a horrible day if you're long of that stock. But from a technical trading perspective, you should never be in this stock anyway, because it's in an underperforming area of the market. And it is, you know, you can see the trend is so aggressively downwards. If anything, you would have been wanting to be short this stock, but you certainly wouldn't want to be long, right? Again, here, Walt Disney, also in the communication sector, weak, looks like it's heading back to those prior lows at $90 a share. Warner Brothers, also horrible, drifting into the bottom right corner of the page, right? Dish, weak. Electronic Arts actually looks a bit better than some of the other stocks in this sector. Meta Platforms, the metaverse, Mark Zuckerberg, goodness me. Look at this, weak, just trending lower, below all the moving averages. And then, of course, last week with the earnings, the stock got absolutely pummeled. And I think there's like, I don't know how many, a hell of a lot of billions of dollars wiped off market cap of Meta that day. Fox Corporation is weak. Okay. Here's Google, continues to head lower into the bottom right-hand corner of the page. So again, this is what I was saying to you. You know, if you think Google's cheap, you want to, and this is common way of amateur traders to think, as I say, oh, Google's fallen so much, it's down so much, it must be a buy, I've got to go and buy some. No, look at that. That is an awful chart. You know, there's a hell of a lot of overhead supply up above you there. Yes, it may have a short-term bounce, but it's very, very weak. And your high probability trade here is not to be trying to pick bottoms in such a weak stock. Okay. Netflix actually is one of the outperformers in this particular sector, I'll say. it has done fairly well recently with that break above $250. But before that, it was very weak. Okay. Let me not carry on going through each and every one of these charts, boring you with it. I think I've probably made the point fairly clear. Okay. The idea being you want to try, and if you're wanting to play the market from the long side, you want to be ideally playing it in the strongest areas of the market, looking to try and identify the strongest sectors and then look for the strongest sectors in those areas of the market. And if you want to be short in the market, look to do it in the weakest areas of the market. That way the momentum is on your side. Okay. This is the communication services sector, just as I showed you a moment ago. Okay. So the Twitter, we didn't look at that chart, but Twitter is the strongest, and you'd understand why. But Twitter's no longer listed. It's been taken off the market. Elon Musk has bought it out, but clearly it was the outperformer because it was the subject of a buyout. Netflix has been strong, but then down the bottom there, you've got all these others, Google, Viacom, etc. These are all very, very weak stocks. Okay, so again, I'm getting towards the end now so that I can take some questions. Look at it like this. Yeah. Again, we've put all of the major sectors of the market into these buckets. We've got the green bucket, which is the relative outperformers. The yellow bucket is the neutral stocks. The red bucket is the underperformers. What you would then also have within each of those is you'd actually then have a red and a green and a blue and a yellow bucket within each one, if you will. So you'll have inside the weak area of the market, the underperforming area, you will actually have some stocks that are outperforming their sector, some that are neutral relative to their sector, and some that are strong relative to, that are very weak relative to their sector. Just think about what we looked at now with the communication services sector. I mean, you've got Google, which is very weak in a weak sector of the market, right? That goes in the reddest of red buckets over there. But then you've got a stock like Netflix, which was actually doing okay, albeit that it is in a weak area of the market. So that would probably slot into that little green bucket inside the red bucket, if you know what I mean. So it's a relative outperformer within its sector, but the sector itself is weak. And then over on the right-hand side here, you've got your outperforming areas of the market. So you've got a thing like the energy sector, which we said is outperforming. But then within that energy sector, you will also have stocks that are outperforming the sector, stocks that are neutral relative to the sector, and stocks that are underperforming the sector. So think about the ones we looked at, which was the strongest. ConocoPhillips was the strongest stock in the energy sector, outperforming by a mile. And then you also had some in the energy sector, which were not as strong. There were a couple of charts there that didn't exactly light my fire. The idea being this: if you're looking for high probability ideas to play on the long side, you want to probably be looking in these areas of the market. So the strongest areas, strongest stocks within the strongest sectors of the market is where you want to be fishing to try and find the best long ideas in terms of high probability trades. Opposite to that, if you're looking for shorting opportunities, you'd probably want to be looking to try and find the weakest sector, the weakest stocks in the weakest areas of the market. Okay. This is, and again, it's not gospel, but it's a way to form a foundation for high probability trading opportunities in terms of doing your research. So if we summarize before I get to questions, this is effectively the steps we'd go through. You begin by filtering through all the larger market sectors, okay, like we did. Then you filter out the sectors into outperformers, underperformers, and neutral. And then you look through each of the sectors and look inside the sectors, look at the stocks, identify which stocks in the sectors are outperforming, which are underperforming, and which are neutral. And then look for long trading ideas, preferably in the outperforming buckets, and look for short trading ideas, preferably in the underperforming buckets. Okay, and like I said, this is not foolproof, but it does provide a high probability starting point when looking for stocks to buy, to go long, or sell to go short. All right. And then the next webinar that I'll do for you next Thursday is seeking high probability chart patterns. That's the 10th of November next week. And that's where we'll then take this exercise one step further and say, right, we've now decided we like the energy sector. We want to be looking for stocks to buy in that sector, but what kind of chart patterns do we want to try and identify within the sector? Okay, so that we know that we've got probability most heavily stacked in our favor. And what I would be looking for in that energy space is probably stocks that are making things like little bull flag consolidations, little falling wedges or triangles or whatever, some sort of consolidations patterns within an overall strong trend that are likely to break to the upside. But we'll talk about that more next week when we look at identifying high probability chart patterns. Right. So for this part of the course, this webinar, that's it in terms of my presentation. We've got about 15 minutes left. So what I'm going to do is I'm going to stop my share here and see if I can open the questions. Yeah. So there's a Q&A box that you've all got. And if you have any questions, you can pop them into that Q&A box, and I'll now go through them all one by one. So we've got some questions from Anonymous, right? Oh, well, they're all mostly anonymous. Okay. So someone asked, can you do the same on South African stocks using stock charts? Good question. South African stocks are not covered on stock charts. You can get them on other charting platforms. So for example, for my own South African trading, I use Metastock as my technical analysis platform for analyzing South African stocks. It's quite an expensive platform. And to be honest, the only reason I still use it is because old habits die hard. I've always used it and I'm familiar. I know my way around it. But if I was coming at it fresh today, I'd probably rather use something like, like TradingView, which is the guys who are giving away, as Gary mentioned, they're giving away a premium membership. They offer brilliant charting on South African markets. So tradingview.com, investing.com, that's where you can look to get charting on South African stocks. Right, then someone else has asked, what time frame do I trade in? So again, a good question. The time frame that I use for most of my analysis is I start with weekly charts, first of all. So it's kind of a process of start from a bigger picture and then zoom in. So I start with weekly charts, then I look at daily charts, then I generally go down to hourly charts. I seldom go much below the 1 hour chart. Most of my main analysis is done using the daily charts. And keep in mind, that's just for my style of trading. I know there are different styles of trading. So some of you may be intraday traders trying to scalp a couple of small movements intraday, in which case you might then drill right down into like a 5-minute chart or a 10-minute chart. But for my style of trading, where my holding time is generally a couple of days to a couple of weeks at a time, I'm mainly looking at daily charts for my analysis. And I often then execute off the hourly chart. Okay, and then Mark, hi Mark Watchorn, you say, what platform do I use to assess relative strength of the SA market? Okay, so I think I've answered that already, the previous question. Then Dave, you said, what are the signs you look for to help you determine that a rotation is taking place from the outperformers to the neutral or underperformers? Okay, this is an excellent question. Do you consider the macro backdrop and then wait for technicals to give you the signal? Can you run through a chart pattern? Okay, my thought pattern. Yeah, so, okay, good question, Dave. To identify the rotation, there's on stockcharts.com, actually, there's a thing called relative rotation graphs, and they were invented by a guy called Julius de Campenaar in the Netherlands. I actually did a podcast with him recently, and he's got a very interesting way of how he takes all of these relative strength charts that I've looked at here, and he then goes one step back and he says, well, what are the changes? Where are the, it's all very well for me to say that the energy sector is outperforming, but what if the rate of outperformance is starting to slow down? Okay, and you can use relative rotation graphs to do that. If you don't use relative rotation graphs, what often you can also do, and I guess I'll spot this with an experienced technical eye, is on those relative strength charts that I've been looking at with you there, you can sometimes get a feel for when they're starting to run out of momentum in one direction or the other, or whether the relative chart itself is about to turn or break through a resistance level or break below a support level. That can also help you then in terms of anticipating when you're going to get a rotation from one area to another. Okay, there's quite a lot of you that have asked how you do this on the SA market. So those questions I think I've asked, and I'm going to skip some of those questions if I've already answered it. You asked, someone's anonymous, you asked, did you select those moving averages on your charts? Yes, I did. So I on all my daily charts, I have 3 moving averages. It's a 200-day moving average, 50-day moving average, and then a 15-day exponential moving average. And those are selected. And the question then, why did I select those? Well, the 50-day and the 200-day are very commonly used by a lot of traders in the market. So that's the one thing. I believe that technical analysis kind of works because people practice it. So it's almost a self-fulfilling exercise. And therefore, I want to be doing the same analysis as what most of the other people are doing, because then they're going to be getting similar readings to me. And then they're going to be, we're likely to see the same thing. And it's likely then that our read of the market is going to be similar. And that just means that you've got also a higher probability of seeing what others are seeing. And the market tends to react quite well to those common technical indicators. All right, then Darren also asked, does stock charts cover South African stocks? So no, it doesn't. Okay, let me find other ones. Lots of you are asking about how you do this on South African stocks. I must say, just on that, I mean, you'll notice I've to a large extent moved my own trading away from South Africa, and I'm doing a lot more in the overseas markets now. It's a lot more interesting. There's a lot more stocks. There's a lot more stuff to choose from. Right. Andrew Swart. Do you typically buy with short-term trades or market orders or limit orders? Okay. It's also a good question. When it comes to orders, sometimes I'll put a limit order in, or sometimes I'll just trade at market. It does depend on, there's a little bit of gut feel and a little bit of instinct that goes into it as well. So fairly often I'll just execute at the price if I'm happy with it. Otherwise, I might potentially sometimes leave a limit order in at a particular level if I'm specific about where I want to trade. But I'd say more often than not, I actually just go with I trade at market most of the time once I've made up my mind that I want to be in a trade. Mervyn, you've asked, will the slides be made available? I guess we can make these available, but this video is also going to be recorded, or it is being recorded as well. So there's that as well. You'll be able to pick up the video again if you want to. Okay, then someone also asks, can one apply relative strength analysis, high probability trading for medium to long-term investments? So yes, indeed you can. You can certainly do that. What might be an idea when it comes to your longer term investments, though, is to do this with weekly charts, so that you're looking at it from a longer term perspective. But absolutely, I mean, the principle does apply both on weekly charts as well as on daily charts, and even on intraday charts as well. Okay, then someone's asking, do you offer training for beginners? My training on my high probability trading course that is online, I like to think it straddles quite a few areas, both for beginners as well as for more experienced traders. So if you go to my website, it's traderscorner.co.za, you'll see there's a link to courses there, and that's where you can actually go and access that course through there, and then you'll see it. All right. Someone asked you, how's the biotech sector performing on a relative strength basis? I think at the moment it would be doing quite well. I mean, I'm not going to have time to go in and show you now because there are other questions being asked here, but biotech forms a subset of the healthcare sector. And remember, the healthcare sector was pretty strong on a relative basis. Okay, then someone else asked you, how do you determine risk reward on your trades if you hold for days or weeks? So the way I determine risk to reward is, obviously you've got to have the way you determine your risk, first of all, is your entry price less your stop loss. That's the risk per share, if you will. And then you would need to have a target in mind, which is, I mean, there are ways to do that through technical analysis by various Fibonacci projections or pattern projections, etc. You can project a target based on certain technical patterns. And when it comes to the risk, I generally don't like to risk more than 1% of my capital on a single trade. So the way you do that, and we will talk about this, by the way, in the third webinar in this series. But you take the risk per share and divide it by how much you're willing to lose, essentially. And that's how you calculate the number of shares that you can afford to buy. But we will cover that in greater depth in the third webinar that we do in 2 weeks' time. Right, what else have we got? Okay. Someone's asking here, would you trade on a systematic basis? Example, buy a breakout above a 50-day moving average when the RSI is above 50. Yeah, you could. Again, you know, there's no one hard and fast way to trade. There are a number of ways to trade. And you often got to find a style of trading that fits your personality best. But what you're saying there is, I would consider that a fairly high probability way to trade. But buy a break above the 50-day moving average when the RSI is above 50. That does kind of put the odds in your favor in terms of being on the right side of the momentum. And I suppose you would then, if you wanted to employ a method like that, put your stop loss below the 50-day moving average or below the lowest point in the candle the day before you bought. That's potentially a way you could trade. I mean, it's simple, but often simple is better. And the simplest ways to trade often are actually the most successful in many cases. Karen, you've asked here, why the 15 EMA and not the 21? It's just a personal preference. That's really all it is. I think I like the 15 because it's a little bit tighter, and it is, and I find if I want to use it as a trailing stop loss, it tends to get me out quicker than the 21-day moving average would. The 21-day moving average has got a slightly longer lag than the 15-day moving average. So if I'm trying to run a profit and I'm wanting to keep running that profit as long as it's above the 15-day moving average, it'll get me out quicker than what the 21-day moving average would do. But it's a personal preference, really. Okay. Okay. There's Herman has asked, can you have a view on Naspers process Tencent in China? Well, I mean, it's been volatile these last couple of days. I think with everything to do with China at the moment, it's the question I suppose one's got to ask is that an investable universe now still? A lot of emerging market investors got very badly burned in Russia earlier this year, and their investments effectively went to zero. And I think that's still fresh in the minds of a lot of emerging markets investors. China now, with Xi having secured a third term, he's not very pro-markets, etc. And that's why you saw the heavy sell-off in the Chinese stocks that you did last week, because the market has interpreted it to mean that the rules of the game are now going to change materially. Having said that, we have seen quite a strong bounce in the Chinese stocks recently. They have recovered some of that, but I don't know. It's either one can take the view that they're very cheap now, which I think they probably are quite cheap. The question is, they're cheap for a reason, because at the stroke of a pen, they can change the rules in China, and they do from time to time. So I think that's also one of the risks. So I suppose I'm going to sit on the fence a little bit with the answer and say, if you want to have an exposure to Naspers or Prosus or Tencent, fine, but just do it with money that you know that if it were to go to zero, it won't change your life. I think not that I think it's going to go to zero. Okay. Don't get me wrong, but just know there's risks there, and the risks have increased meaningfully when it comes to investing in China now. Okay. I think we're almost done in terms of time. So I'll just do the last couple of questions that I can. Someone asked here, what is your preferred asset class re-trading? So for me, it's equities. And they're purely because I've been schooled in equities. I was brought up on equities. My whole career has been in equities. But having said that, I mean, there's lots of things you can trade in the world. There's Forex, there's indices, ETFs, commodities, bonds, all sorts of things. And they've all got their pros and cons. But for me, it's equities. And that's really only because that's where I've been schooled and where my history is in terms of trading. All right. I think that's it really that I can see in terms of questions that need to be asked. And it's pretty much, it's 4:30 my time, which makes it, 6:30 for you guys in sunny South Africa. And I can tell you it's not so sunny right now where I am. It's quite an overcast, miserable day here. The hour's up, so I'm going to end it there. Thanks everybody for tuning in. I appreciate it. I hope you've enjoyed it. And I look forward to joining you again, next Thursday, same time, 5:30 your time, 3:30 my time, where we'll be discussing high probability chart patterns. So have a good week until then, and we'll be together again next week. Thanks, everyone. Cheers.